Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Equity Lifestyle Properties Inc. quarterly report. Our company is a self-administered and self-managed real estate investment trust, REIT, with its headquarters in Chicago. We provide various businesses and services through our extensive portfolio of 455 properties across 36 locations, including real estate ownership, property management, investment opportunities for investors. The decline in Equity Lifestyle Properties Inc.'s stock price over the past year can be attributed to a combination of factors. Despite surpassing analyst expectations for earnings per share and revenue, the company's stock fell due to broader market volatility and challenges related to maintaining growth in Canadian customer reservations. A significant investment in a luxury residential development project in California raised concerns about short-term liquidity, contributing to a 3.76% decline in ELS stock. Proposed regulatory changes in property tax assessments also triggered defensive selling among investors, who fear that the new framework could increase taxable value calculations by 15–20% for commercial properties. Broader macroeconomic headwinds, including a rise in 10-year Treasury yields and sluggish Q2 2025 performance, have further exacerbated the decline. Analyst downgrades and price target reductions from Wells Fargo & Company and Wall Street Zen also contributed to the stock's downward trend. Overall, the decline in Equity Lifestyle Properties Inc.'s stock price is a result of a complex interplay between market conditions, regulatory uncertainty, and company-specific challenges. The primary drivers of revenue growth or decline can be summarized into two main categories: investment in real estate and membership subscriptions, as well as various forms of income such as interest, utility, and home sales. Revenue growth is primarily driven by an increase in net investment in real estate, rental income, annual membership subscriptions, and interest income. Additionally, the company's gross and net investments in new manufactured home rental units contribute to revenue growth. On the other hand, revenue decline is attributed to a decrease in mortgage notes payable, net, as well as a decline in various forms of rental income, such as seasonal RV and marina base rentals. Furthermore, membership upgrade revenue and gross revenues from new home sales also contribute to revenue decline. Net income and profit margins. A shift towards growth. The financial performance of a company has shown a positive trend in recent quarters. Net income has increased by 15.6% in Q3 2025 compared to the same period in 2024, reaching $100,363. This growth is also reflected in the 9-month period, with an increase of 5.2%. The net income per fully diluted common share has seen a 12.9% and 2.5% rise in Q3 and 9 months respectively. Profit margins have also shown improvement, with the net income margin increasing to 24.9% in Q3 2025 from 22.3% in 2024. The 9-month period saw an even higher increase, reaching 25.7%. However, there was a slight decrease in NOI, net operating income, margin, dropping from 47.3% in 2024 to 48.8% in 2025. The reasons behind these changes are not explicitly stated, but the overall trend suggests that the company is experiencing growth and improvement in its financial performance. The company's financial performance indicates a consistent generation of positive operating cash flow. As evident from the data on page 14 and page 43, the net cash provided by operating activities has been steadily increasing over the years, with figures standing at $471,687 in 2025 and $491,404 in 2024. This trend suggests that the company is effectively managing its operations to produce a surplus of cash from its core business activities. The company's debt level has undergone significant changes. While mortgage notes payable decreased by $135,514, interest expenses have also seen a substantial decline from -$8.657 million to -$2.384 million. Furthermore, the estimated interest expense for the next 12 months is significantly lower, at $0.1 million. The introduction of an unsecured term loan agreement in May 2025 and the repayment of the $300 million term loan in October 2024 also indicate a reduction in debt obligations. Management is optimistic about the company's outlook, citing strong revenue growth, 1% increase, and net income available for common stockholders increasing by 6%. They expect demand from baby boomers to remain strong due to second home sales, while also anticipating high levels of demand from millennials and Generation Z demographics. The company aims to increase cash flows and property value through efficient management of properties. Management is prioritizing liquidity and capital resources to meet short-term and long-term requirements, but acknowledges risks associated with the real estate industry, including economic fluctuations and competition. The company has a history of paying dividends to its shareholders. In 2025, it paid out $97,130 in net income available for common, while in 2024, the payout was $82,821. This indicates that the company prioritizes returning value to its investors through dividend payments. Concerns about inventory buildup and supply chain disruption are evident in the financial summary. The impact of natural disasters, such as Hurricane Ian, has resulted in debris removal and cleanup costs, indicating potential supply chain disruptions. Additionally, tightening labor markets and changes affecting the supply chain pose a risk factor, making it challenging to obtain materials and skilled labor on time without significant costs or delays. That concludes the financial summary for Equity Lifestyle Properties Inc. Feel free to comment below, and I will be happy to answer them when possible.